few days ago, Tom Lee went on CNBC and was asked what he is buying in this crazy market. Meanwhile, S&P 500 had a disastrous beginning of the year with almost all the sectors is in the red, especially technology, consumer cyclical, semiconductors, software. Almost everything is red except consumer defensive, except telecoms and healthcare. Meanwhile, the big banks are projecting the 60% chance of recession, and Polymarket is projecting 51% of recession in 2025. Meanwhile, last week we had a huge rebound, and if you can see, almost every single stock in S&P 500 is deep in a green, with Nvidia almost 14%. Visa, MasterCard, Apple 13%, Microsoft 8%, Broadcom 15%, Tesla, Walmart, Costco, everything is green. And last week we had second best day for QQQ in the history. And after I was doing some research what happened last time after the best day of QQQ, I found that it happened in 2001 and it was not the bottom. After that, QQQ made another 4 lows. That's why it's too early to confirm that the bottom is in. That being said, let's see what Tom Lee is buying for his clients, and I will give you my opinion about these stocks.
With all this volatility, where are we going? Let's ask Tom Lee. He is FundStrat's managing partner, head of research, also a CNBC contributor with me here at Post 9. Thank you for being here. So, Liberation Day didn't go as you thought, and you apologized publicly for that, which I think a lot of people appreciated. You're always a stand-up person about that. What now? Where are we going?
Well, I think a couple of things that we're thinking about is we know markets have gotten very pessimistic. They've priced in a 60% probability of a recession. And if tariff negotiations de-escalate, then the probability isn't that high. So I think that there's still a big window for markets to have a large rebound, but it's really the path of this de-escalation.
Are we in a bear market? I mean, we're in a bear market, right? I mean, it almost doesn't matter, textbook, whether you say we are or not. It's like so many stocks got just absolutely destroyed before this uncertainty happened in the market.
Yes. I mean, if we define a bear market as stocks feel like a grind or you're losing money, I'd say it really started in December because markets were churning even through the February high. But if I was to define a bear market as unleashing a type of financial tightening that leads to a recession, we're not at that criteria yet. But I think it feels like a bear market for the average person.
Are we supposed to buy into that? Or just stay cautious and on the sidelines, don't do anything, sit on our hands? I don't think people know what to do. And I'm not just talking in the CEO suites, because they obviously don't know what to do. How can you? So what is the investor supposed to do?
Yeah, I mean, I think there's sort of two brains people are fighting. One is the tactical brain, which is, look, they want to know if this is a bottom, and they want to be convinced of it by seeing stocks rally on bad news. But if someone had the investor hat on, and, that's the long-term brain. I have a lot of confidence the U.S. companies are going to navigate through this treachery. Stocks are hugely oversold because you never really lose money buying the VIX at 50, or when the percentage of stocks above the 200-day drops to 15. Those are almost guarantees of positive 1-year, 3-year, 5-year returns. So it depends which brain you're wearing today, but I'd say the majority of our clients are trying to be tactical.
I hear views of, well, it's really hard to get uber bearish now because a headline at any moment, as I said in the open here, the market is waiting so hard for some bit of good news that if you're on the wrong side of that, you get a day like you had on Wednesday.
Yes. I mean, if I was to oversimplify the framing of this, U.S. and China have absurd levels of reciprocal tariffs at the moment. And if you believe those are in place, then the global economy is in trouble and you should be bearish. But if this is a matter of who makes the overture first or blinks, but we know it de-escalates, then I think the downside it comes off dramatically, and I think stocks can actually do really well into the rest of the year.
So you'd be a buyer right now?
Yes, and with the apology that, of course, I didn't think Liberation Day was going to be this draconian, but yes, I would be buying stocks today.
What would you buy?
Well, one of the things we did for our clients last night is to look at what's called Walter Deemer calls sold out stocks, which is worse than oversold. Sold out stocks don't go down because there's a lot of bad news priced in. Mm-hmm. There's a lot of stocks that didn't make new lows on Tuesday, April 8th. They made their lows a month ago, and they had lower volume on April 8th. Those are what I'd call washed out stocks. A group that I think's washed out is the Mag 7. So I'd look at Mag 7 as a place to really expect a rebound, including stocks like Tesla.
Okay.
Tom Lee is bullish on the Mag 7, and let's go through all Mag 7 stocks to see do I see the opportunity in Mag 7 names. Starting from Apple here, Apple had a drawdown of 33.4%, absolutely disastrous drawdown. And this, of course, was caused by tariffs and huge tariffs, 145% on China. And Apple has 90% manufacturing in China. So, of course, if these tariffs stay in place, this will have significantly negative effect on Apple. Recently, there was a news about the exemption of smartphones for the tariffs, and today Apple is jumping 3.6% on this news. But if we are considering the fundamentals of Apple business, the revenue growth over the last 3 years is 1.5%, which basically no growth, and the forward revenue growth the analysts expecting around 6%, and I'm not sure, I'm not as optimistic as analysts. And EPS growth over the next 2 years is 9.2%. The difference between the revenue and EPS is because Apple has a huge buyback, so EPS will be growing faster than revenue. In terms of the valuation, Apple is trading at 27 times forward price to earnings and 25 times forward price to free cash flow. I think this is quite expensive for the company, which over the last 3 years was growing basically flat. 1.5% is lower than inflation. And even though analyst is pricing some growth over the next 3 years, I'm not as optimistic, so I'm not buying Apple at these prices. Coming to the next company in the list, and this is Alphabet. Alphabet has a drawdown of 30%, and Alphabet is not as affected by tariffs as Apple because Alphabet is more like a digital advertising company. Most of the money is coming through the ads. But the problem for Alphabet is that if we are seeing the huge probability of recession in 2025 or 2026, the problem is that consumer will cut spendings and advertisers will not have as big advertising budgets. So in this case, the revenue could have a slowdown. But operating with the past numbers, revenue over the 3 years was growing 10%, and for the 5 years was growing 16%. Forward revenue growth is still double digit, low double digit at 11%, and EPS higher at 12.6% because of the buyback from Google. In terms of the valuation, Google is trading at 17.5 times forward earnings and 25 times forward free cash flow. The problem why free cash flow number looks more expensive than earnings number is because Google investing significantly in capital expenditures and building cloud. But cloud recently is showing beautiful operating leverage, and they already started generating multi-billion-dollar run rate business. So I see a lot of potential in the cloud. And also we see a lot of news about the Waymo expansion, and Google is catching up with AI, publishing the new version of Gemini, which is beating benchmarks and beating other competitors in the field. I see some market share lost in a search, but I believe at forward 17 times earnings, this is definitely priced in, and we see other parts of Google's business segments like cloud keep growing, and now Google is becoming more diversified, not just advertising company, but more diversified company. This is very, very nice to see. And I was buying Google at this drawdown. I did not catch the real bottom, but I was definitely DCAing down and built more position. Currently, I already have a long position in Google stock. Coming to the next company in the list, this is Meta Platforms. Meta Platforms had a correction from this tariff situation of 31%, and Meta is very similar to the Google. Meta is mostly advertising company. Most of the money is coming from advertising, and also Reality Labs, which is currently a money-losing machine. Meta is still growing at 11.7% in the last 3 years, and analyst is projecting accelerating to 13.7%, and from the earnings perspective, a little bit slower at 10% over the next 2 years. From the valuation perspective, Meta is trading at 21.7 times forward earnings and 31 0.8 times forward free cash flow. Similar to Google, the free cash flow number looks bigger because Meta is significantly investing in capex, building the supercomputer, buying GPUs mostly from Nvidia and other players to invest in AI and also in augmented and virtual reality. For me, I already have a large position in Meta, so this 30% drawdown was not enough for me to start buying. And also from the technical perspective, Meta could go a little bit lower just from the technical perspective. So for me to buy more Meta, I need a little bit lower prices, and also I see bigger opportunities in Google, so I pulled the trigger on Google stock first. But if Meta continues to go down 50%, I definitely will make sure to pick up more shares of Meta platforms. Coming to the next company in the list, and this is Amazon. Amazon has 30% correction from this tariff situation. Amazon is very diversified business model, has retail, has AWS, has advertising. Revenue over the last 3 years was growing 10.7%, and projection for the next 2 years is a little bit slower on of 10%, and for the earnings per share is basically double of revenue growth of 16.8%. From the valuation perspective, the forward PE is north of 30 and the forward price to free cash flow of 38. I believe that Amazon has a significant operating leverage because of the robotics and because of the optimization. Amazon is generating a lot of money in revenue. You can see here Amazon is generating $637 billion. This is a lot of money, and I believe just percentages optimization in warehouses using robotics and replacing people into the robots will give Amazon significant operating leverage. I believe that Amazon is a buy at these prices, and usually I'm valuing Amazon not by price to earnings and not by price to free cash flow, but price to operating cash flow. And for that, Amazon is trading at 10-year lows. So I believe Amazon is easy money here. Coming to the next company in the list, and this is Tesla Maesla. Tesla Maesla was having north of 50% drawdown from this tariff situation. Tesla has factory in the United States, but also has factory in China. Tesla is a global company and has a global supply chain. So Tesla is affected by tariffs, even though most of the cars sold in the United States was manufactured in the United States as well. Currently, we can see that Tesla over the last 3 years was growing 22%, but of course Tesla was affected by increase in interest rate, which is headwind, of course, for the company. Forward revenue estimation for the next 2 years is 15%, and for the EPS 20%. From the valuation perspective, Tesla is still expensive at 98 times forward earnings and 166 times forward free cash flow. Investors are bidding significantly to buy Tesla stock because they believe that Tesla is the future robotics company, and the Optimus will be used in factories to improve the efficiency, but later this will be business to consumer, a business model where the Optimus will be sold to normal people, you and me, and we'll be able to buy that to wash dishes, to do laundry, and etc, etc, etc. I have a small position in Tesla. I would like to increase this position because I believe that robotics is the next $0 to $1 trillion industry, and I just do not see another company which will allow me to capitalize on robotics as much as Tesla. For me, one of the other biggest bet on robotics is Amazon, because as I mentioned, Amazon has a huge revenue, and robotics implemented in warehouses, in shipping and optimization, all that stuff will give operating leverage to Amazon, which will print significant amount of free cash flow for investors. So Amazon and Tesla is definitely one of the top robotics company in my list. And coming to the last company of Magnificent Seven, and this is Microsoft stock. And Microsoft is one of the best businesses in the world, and we can see that Microsoft basically was not affected by tariffs. Why? Because Microsoft is not really a manufacturing company. Microsoft is a software company, with most of the revenue is recurring revenue. Microsoft is top 2 biggest company in S&P 500, and meanwhile still growing at 12.3% over the last 3 years, and revenue projection over the next 2 years is accelerating to 13.3%, and from the EPS perspective 12.7%, absolutely amazing. From the price to earnings perspective, 28.2 times forward earnings, and from the perspective of price to free cash flow, a little bit more expensive at 38 times. I believe that Microsoft is a brilliant business, and In my portfolio, I own all three hyperscalers. I am very bullish on hyperscalers. For Microsoft, he was a little bit more expensive, so I first bought Google and Amazon, but once Microsoft gave me more attractive price entry during the last week, I was buying and building a more bigger position in Microsoft stock. Very bullish on this company for the long term. And there you have it. If you are interested in other companies in the top of my watch list, what I'm buying during this market crash, watch this video next. Thanks for watching, and I will see you in the next one.